Good morning, everybody. My name is Prentice Durbin. I'm a partner at Harper Gray, a law firm in downtown Vancouver. We're a regional firm. We just have the one office, but we're very proudly well established in Vancouver, having been here for or established for the past over 100 years. I'm delighted to be part of the Angel Forum and Vancouver Startup Week, and just, you know, it's just such an exciting week every year. This one obviously is a little different for all of us. Anyway, today's topic is about equity, debt, safes, raising money in your company. We'll cover all sorts of topics in here. Once we get going, Irene's going to actually share with us my slide deck, and then we can sort of kick into gear. So just before we get there, just part of what we do, we spend a lot of time here at Harper Gray. My colleague Steve Lucas and I and our team, we spend a lot of time in the tech space, startups, angel rounds, friends and family, then going up to seed, Series A, Series B, cross-border, and all the way up to an exit event, liquidity, whether that's going public transaction, which doesn't happen all the time, or actually a sale to another firm. So, and in between all of that financing stuff, there's obviously all sorts of issues. So we'll talk about that stuff as we get going. So I'm going to talk first, sort of the order of events will be start off with equity, go to debt, then we're going to talk about convertible notes and safes, and then just sort of recap in terms of what else is out there that will I'm sure not wait till the end, but will come up in the meantime. And then I'll just ask Irene, if you see a question that comes up in the chat room, Irene, feel free to interrupt me, and we can address that as we go. Happy to take questions on the fly as well, and I'll just again, Irene, I'll lean on you to bring those questions up. So
okay.
There's really three ways to raise money for a corporate setting. And again, I am talking about companies, and I'll really focus on BC companies to keep things simple. You either raise money and issue shares, which is equity. You borrow the money, which is in the form of a loan, or in certain circumstances, you can get given money, and that usually comes in the form of grants. So things like our the IRAP, SHRED, other functions that are federally or provincially sponsored, but incentives in place to help create an economy effectively. The entrepreneur is celebrated in the fact that there are these tools out there to help the entrepreneur raise money, employ people, and create locally. So let's start with...
Can you see my screen now?
I cannot, but I'm going to...
Yes, good. And now it seems that Prentice is refreshing and left the meeting.
Yeah, I'll be right back. Hang on.
That sounds good. Can you see it, Prentice?
Yes, I can see it. Thanks, Irene.
Perfect. Then if you let me know when I need to move to the next slide, then I'll do that. Thanks.
Sure. Yep. Go ahead. You can click through. That's just our title page. The next slide is the outline that I just walked through with equity, debt. Is that working, Irene?
See, I have several. Hang on, then oh dear. Can you see now that it changed to the outline?
Yes.
Good. Perfect.
Okay. And we'll go to go over two more slides, please. Okay, so what is equity? What is a share? A share is, it's evidence of ownership in a company. It basically gives you, in its most basic form, a right to vote and a right to participate in the assets upon a distribution, or a right to receive a dividend. But it's the component of you have invested in this company, and it's a way to take money out of the company and participate in the equitable value. You can have all sorts of numbers. Go ahead and click, Irene. It will go up line by line.
Okay. Oh, man. There we go.
So you can have all sorts of numbers of shares. You can have, 1 or a million or whatever. There is some method to the madness in terms of how many shares you get. Some numbers are better than others, and we'll get into that in a little bit later. What rights does the share have? Really, it's all about, again, fundamentally, you have a right to vote, and you have a right to vote as a shareholder for your directors, and certain other things. But what it doesn't give you necessarily is a right to all the information. You as a shareholder have a limited liability, which is limited to your investment in the company. So if you put $100 into the company, that's your exposure. And that comes obviously with, again, its own limitations. You get a right to vote and you get a right to dividend, but that's about it. Next is just about how many classes can you have? Well, you can have a gazillion classes. And I'm sure many of you have seen or heard of companies incorporated with A through Z shares. They'll have all sorts of bells and whistles like par values and not for par values and voting and non-voting and the like. So you can have any number of share classes. The problem is that in our startup world, too many is actually a more complex thing, and it causes problems. So we actually try to incorporate companies with just one class and stay with one class as long as you can. We'll get into that a little bit later too. Are all share rights the same for a specific class? In short, yes, but many of you probably heard about series of shares as well. So there are classes of shares like commons and preferreds, but you might encounter a series of shares, and a series is typically, and certainly in British Columbia, within a class. The shares of a class fundamentally have all the same special rights and restrictions. There are a few ways to vary those special rights and restrictions between series, and that can be things like a dividend rate or a price, but otherwise that whole class participates on liquidation altogether as one. Because of all these bells and whistles, we always have to wonder, what do we call these shares? And they can be called anything. Just yesterday I had a question raised about, can I have another class of common shares with a dividend, or do I have to call them preferred shares? And my answer was, doesn't really matter what you call them. If you look at various corporate structures, many companies have Class A shares, Class B shares, Class C shares. They never actually use the word common. What common and preferred can mean, and often mean to us, is that common are the regular shares and preferred have some preference of some kind. But just because they're called preferred doesn't mean that they have the preferences. That is really baked into the text of the special rights and restrictions attached to them. So we can call them anything we want. They typically have a name that makes sense to them, to the reader or the investor or the company itself. But it's really all about the substance of the share rights rather than what they're actually called. Okay, on the next slide, we just talk about, again, more classes of shares. We can have common voting, common non-voting, preferred voting and non-voting. Irene, if you just click through, it will sort of list these for everybody to see. And then you can also have conversion features. And what you'll often see is in a venture capital round, for example, you'll see shares that are put into place that have conversion features or voting features. And the voting is really all around. They want, because it's a separate class, we have to specify that they'll have a right to vote for the directors along with the common shareholders. But that's spelled out again in the special rights attached to them. There's also redemption and retraction features that can baked in. We can really put all sorts of things in these share rights, and they can be, extremely complex with multiple pages, or much more simplified. Another feature that you'll often see is restrictive covenants in the share rights, and again, that just means that you're not allowed to do certain things. And some of those are an easy one to give an example of is if you have a common share and a preferred share above that, the preferred share may have a restrictive covenant that the company is not allowed to create a more senior or a second class of preferred shares that rank higher without that existing preferred share class approval. So you can, again, put all sorts of bells and whistles in these things. And if you're silent on them, there are no special rights. So you need to sort of build those out, and they can all be different as well. We get the question all the time. Well, just, throw together what you normally would. Like just pull something off the shelf and that should be fine. The problem is that, it's never fine. And there's always several factors that are specific to your deal, or specific to your company, or specific to the investor coming in. And so it really is not the case where it's one size fits all. So just have to be careful about that. We've talked a little bit about this next on the next slide, Irene, thanks. There's just talking more about features. Again, the commons basic, they vote, they can have dividends, they participate in the assets. You could have a common class that is non-voting. Again, they could have dividends and assets. There's a couple things, though, that even a non-voting share class still has a right to vote on. And two examples of those are waiver of the auditor, which is always a sticking point for companies that are growing. How do we deal with this waiver? And then another right to vote, regardless of the share being called a non-voting share or having non-voting rights, is that if you are prejudicial to that class or interfere with that class, that's the language in the act, that class has a right to vote nevertheless. So often we come across wait a second, these shares are non-voting. They don't have to, why do we have to get their vote to waive an auditor? Well, that's one of those fundamental rights a shareholder has, is the right to see the financial state of the company. And where the sticking point arises is when a company doesn't report well financially or to the satisfaction of the investor, that investor can say, I think you guys need to go get an audit. Otherwise, show me why we shouldn't. And every year, and many of you have probably seen it, there's a resolution that's produced by the law firm that says, we hereby waive the appointment of the audit for the current year. And again, all shareholders need to sign that resolution or vote in favor. It's a unanimous thing. It's not a majority in order for it to comply with it. So just give you the heads up, it's a little warning sign that just even though the shares are non-voting, they sometimes still get the right to vote. Okay, next slide. More features about preferred and voting. Talked a little bit about this already, that preferred shares can still vote with the commons if they have that feature. We've talked about conversion. Again, where this arises in a venture capital preferred share context is in the event of a liquidity event. So perhaps that's going public in an IPO, or maybe it's a sale of the company for a high enough price the preferred shares will have a feature and that permits them to convert so that they can participate in the distribution of the assets. And typically that conversion kicks in when the preferred holder is going to get a little more. We talked a little bit about restrictive covenants on preferred shares. There's also, we can have anti-dilution rights in there, or ratchets, price protection features, so that you as the preferred shareholder aren't undermined by the company going out and raising money at a lower price. I'm going to stop there for a minute. I'm not sure if anything's popped up on the chat, but now's a good time to raise a question. Or Irene, have you seen anything come across?
No, excuse me, I don't see any questions right now. Feel free to type away. I will just check in, like, let's say every 10 minutes. So if you have questions, please forward them over chat. None now, so let's continue. Oh, there someone entered. That's good. Okay, let's continue, Prentice.
Super, thanks. Okay, so enough about shares. Let's talk about capitalization and how we set up a company to when we initially incorporate it. So here in BC, it's very common to create an unlimited number of common shares. What that means is we can basically issue as many shares as we want, and the company or those shares have been authorized. It doesn't mean they're issued. It just means that you're allowed, or the company's allowed to issue them. We go with an unlimited number, only because it makes life easier. If you were to cap your number of shares at, say, 1 million, in the context of a startup, you'd probably have to go back to the shareholders to get approval to increase that number, because you'd want to increase more shares. So we just make it easy, authorize an unlimited number, and then we start issuing shares to round out what that should look like. Founder shares. So again, when we incorporate initially, we've got to have some shareholders, and that's usually the entrepreneur or the founder, or a group of founders or co-founders. And what's important to know is that we don't typically give them a separate class. We want the shareholders to be all in one class for as long as possible. And the reason is control. So even though you might say, okay, the founders have 90% of the company in one class, and we create a second class for the initial investors, by putting those investors in a separate class, you're actually giving them a veto right. And that goes back to a couple slides ago when we were talking about, that prejudicial or interference with a share class. You're putting a lot of power into that second class of shares. And so what's preferred, certainly what I advise clients on, is stick with one class, keep it simple, maintain the majority of that class for as long as you can as a co-founder, and you'll be able to vote things through and keep control. So even things like voting of directors and fixing the number of directors, the boring stuff, it's easy to do. And if you ever got to a point where you brought in some investors and wanted to create a preferred class, for example, you control the commons and can, again, approve that new class to come in. If you had a second class, you risk the component of those investors saying no. And, what happens then? I mean, it really becomes a business decision at that point. But, from a legal context, they do have a veto. We typically issue about 4 to 6 million common shares to the founders. And that's the whole founders group. So if there's 1 or 3 founders, we're still going to typically put about 4 to 6 million shares in their hands. The only reason for doing so is it just makes the numbers work once we get down the line. I've got some samples of share cap tables and a few slides that we can sort of demonstrate how that works. But the idea is about 4 to 6 million. If you provide a lower number, you just don't have the room to dilute. And if you have too many, although people like lots of zeros before the decimal, it just becomes meaningless because it's really about the percentage ownership. We'll get into that a little bit later. But 4 to 6 million for the founders, and we issue these at a really low price. This is the initial block. We issue 4 million or 5 million at fractions of a penny because no one really has the money to pay $1 a share. Obviously, writing a check for that $4 or $5 million doesn't make sense in this context because these shares are really all about sweat equity. It's about the time that the founders are going to put in over the next months or years to kick this thing off and get it going. And so, these initial shares are, cheap for that purpose. Your payday, you're pushing out to a later time. It trickles into a little bit about how much salary should the founder get? And the answer is pretty much as little as possible. Put bread on the table and that's about it, because your payday is really, in the sale of the shares down the road somewhere. We can get into that a little bit later too. So recognize that it's sweat equity that you're going to contribute over the next few years and the nominal price. We really should only be issuing these shares, to the initial people, okay? The founders or, the first CEO, really the people that are the creators of the idea. Quite often I see that a company is incorporated and then a year later we start talking about co-founders. And I struggle with the concept because they're not really a co-founder. They're just someone that you are really, you value them greatly and you want to put some equity into their hands. There are, other ways to do it through options or the like. If nothing's happened in the company, it's certainly easier to give them those cheap shares. But, that's sort of a statement of fact in terms of what's actually happened in the company between incorporation and that person coming on. The founder has been through it the whole way. They've gathered this initial team to get going. Are they founders? It is sort of up for debate. But what we shouldn't do with these cheap shares is just throw them out to employees or investors. That's not the purpose of this class. The investors should be subscribing for shares for real money, even though that might be 10 cents, 5 cents, 25 cents. And employees shouldn't be getting founders shares. We typically grant them options. They can be cheap options, but use the option mechanic rather than the founders shares. Again, think about the founders shares being those issued on incorporation right from the get-go. Some of the common mistakes that, in addition to the ones I just mentioned, when we have multiple founders especially, we want to hold each other's feet to the fire. And we have to sort of think about, how long we need the co-founders to work together. And it's really an issue between the co-founders. And sometimes it bleeds into an issue for the investors because they want to make sure that the co-founders are committed to the business and the startup for at least, for example, 2 to 4 years. So the mistake is that we don't actually get these co-founders to sign what we call reverse vesting agreements. If you're not familiar with the term, it's sort of a backwards way of earning your shares. We issue them their 4 to 6 million shares, but the company has this right to pull them back if the co-founder leaves too early. And it's not typically pulling them back entirely. There's usually a sort of a process. Again, if we wanted the co-founder to be around for 4 years, maybe we say that 25 will vest each year. So if the co-founder hung around for 3 years but left, that last 25% would be pulled back The company would have the right to repurchase them for that original cost. And again, it goes back to the sweat equity component. The deal at the beginning was, we need you for 4 years. If you bail early, you don't get all your shares. So pretty simple concept, but again, overlooked in the niceties of the initial honeymoon phase of starting the company. It's so easy to sort of gloss over a lot of this stuff, and some people don't want to offend their co-founders by asking them for these things. So it's important to address the issues early. You sweep it under the carpet, you might be asking for trouble later on. And the other thing about the founder shares, which we said before, is just issuing them to the wrong people. So again, that 4 to 6 million is really stick to the true co-founders, and don't let it bleed to employees and investors. Okay, so let's move on. We're going to move on to share cap tables, and I think this is
Francis.
Yeah.
I have a question through chat. Adil has a question regarding founders. Okay, do founders typically issue a percentage of their shares as vested at the time of incorporation?
Well, let's put it this way. The founders issuing the shares will be issuing to themselves 100% of the shares of the company, because there are no other shareholders right from the get-go. It's just them. But they're going to be diluted. And I think that some of those that question might be answered when we talk through the cap table, because you'll see how the shareholdings of the founders, or those co-founders' shares, the number will stay the same, but their percentage will drop as we bring in more people. So let's revisit that question maybe in a few slides. So what is a share cap table? It's really sort of a snapshot of the equity that the company's issued or is planning to issue, and it provides an investor, or a lender or a reader, whatever, just that sort of one-page image of who owns what and what percentage. We use it just because it's an easy way to articulate the shareholdings. Another document that gets thrown around is the actual securities register, the central securities register, which is in the minute book. And that document is the actual record of who owns the company. It's a great document. Obviously, it's you have to have one, but it doesn't summarize like a cap table does. The cap table is really good about just summarizing and compartmentalizing and making it easier to read. I encourage the founder or the CEO to really sort of have this cap table at their fingertips. So they're the one that should control it. They're the one that really is updating it. They're the one that is planning for going forward, and they're the one that shares it with investors or people that need to know or want to know what it looks like. It includes all sorts of things. It doesn't necessarily include names, but it can. It might lump certain investors or certain parties into categories. So, for example, you might have the founders, again, not by name, but you know who that is. It'll show the share price. It'll show how many shares overall have been issued. We usually show the stock option plan. But again, it's a snapshot, but it's typically one person. If you're maybe a little bit more mature as a company and have a CFO, they might be the person that really is looking at that, because the cap table actually it has information from the minute book or the central securities register, and it actually sort of bleeds itself into the financial statements because it talks about how much money the company has raised. So the next slide is our first sort of image of a cap table. And we've got a whole bunch of them. So we sort of take this step by step. there's 8 rounds. So we'll sort of flip through this and we can go back and forth. And if anybody wants to go back a slide, just raise your hand or let Irene know, and we can do that. So this first one, again, sort of pretty basic. We've got, this is really on incorporation, and the founders are just issuing themselves some shares. So, going across the top, we have number of shares issued, ownership percentage, the price per share, the funds raised, number of options, and then there's a fully diluted number at the end. And you'll see how that sort of is important as we go. But the idea here is, back to our original comment about 4 to 6 million. Here we've said, okay, the founders are getting 6 million shares. There they've got 100% of the company, or 100% of the shares. They issued them at a cheap price for $600 of funds raised. And at the bottom of that slide, you can see our pre-money valuation was nil, and we've put $600 into it. We've also contemplated that investment's going to come in. So below the founders, we have, it just says type of investor, but we'll see in the next few slides how these end up getting filled out. So who do you go to raise your first money? We typically go to our family and friends. So the next slide is incorporating our family and friends into the cap table. Now, I'm going to pull you down to the bottom left corner and the pre-money valuation number of 1.5 million. So how did we get there? We got there because the co-founders have come up with an idea, and they've got to start somewhere with a number, and they've made up 1.5 million. And there is, yes, there's all sorts of debate that we could say, well, the company's not worth that, or it is worth it, it's worth less, it's worth more. But fact is that it's probably not worth much of anything. And the exercise here is to start bringing in some money at a price that will make sense for not only raising money from friends and family, but also on the dilution side. So if we look at this, the founders' shares haven't changed. They still have 6 million, but we've issued to family and friends 400,000 shares. We've issued those shares at 25 cents for $100,000. By issuing them at 25 cents, we've diluted ourselves. We've given up 6.25% of the company. The founders still have, well over 90%, but they've had to give up something for that. Remember, they had $600 of investment before, and now they've got $100,006. So after the money's been invested, if we go to the bottom right corner, you can see our post-money valuation is $100,000 more than the pre. It's 1.6 million. 6.4 million shares represents 100% of the shares, and we've got 6.4 million shares issued. Usually around this time, and let's go to the next slide, we've got a couple of employees. That $100,000 has allowed us to hire some folks, apply for some funding, maybe from IRAP to get another, few $100,000, whatever it may be. But now we've got some, maybe product developers or software developers or something, but we're paying some people. And as a startup, we can't pay them much, so we want a stock option plan. So this slide introduces a stock option plan, and we put it at the bottom only because it's options, not shares. And so if you see across, we've only issued 6.4 million shares. The ownership percentages haven't changed. The price per share hasn't changed, as it shouldn't. But we've got now 1.5 million options included in the pool, which is a generous pool, as you see, fully diluted, that's just under 19%. But again, it will make sense because that number is going to be diluted down again in the coming rounds. But now we've got options. So these employees that are coming in, we can give them an incentive, right? The whole idea is join us, here's some options, help us grow the company. And when we sell, those options are hopefully worth a whole lot more. Well, it's time to raise some more money, so we go to the angels. We go to Irene's team at the Angel Forum, and we're pitching and we're looking for angel investments. Okay, so in our example here, the angels are coming in for 1.2 million shares, and just skimming across, that's going to get them just under 16% of the company. They're buying at 35 cents a share, but they're writing checks for $420,000. So we've got a big investment coming in. Again, the price is a little higher, but they're taking a respectable portion of the company. The founders are dropping down now. You'll see that just on the share side, they're down at 78.9%. If they didn't raise the money, they'd have 100% of the company. But they did raise the money. The company's worth more, so their shares are worth more. Okay. Bottom left corner, our pre-money valuation has gone up to 2.24. Again, this is a negotiation with the angels, but after they put their money in of 420,000, we're at $2.66 million that the company is valued at after the money's gone in. So down the fully diluted side, or down those columns on the far right, again, founder share numbers haven't changed. The family and friends are still unchanged at 400,000. The angels are now in for 1.2. And if we consider our fully diluted, which means that the stock options have all been exercised, you can see those percentages running down the right side. Okay, it's time to raise more money. So we're going to do a Series A round. Pretend these are venture capitalists. We'll see what kind of shares they're doing. I ignore the different classes in this example. It's really just about the share numbers. But in this one, the venture capitalists are coming in for 3 million shares at 50 cents. Again, the price is going up, and that's generally a pattern that you want to see. You want to see rounds sort of increasing in value every time. Price is at 50 cents. We've raised 1.5 million from them. Yes, the founders are dropping down in the percentage, but again, the post-money valuation here is at 5.3 million. We're significantly higher than that original spot when they just put $600 in, or when the friends and family came around and we valued it at 1.5. At this point in time, though, the venture capitalists, the angels have negotiated a valuation. The venture capitalists in the Series A round have negotiated a valuation. There's a lot to be said for what you can hang your hat on here. They're third parties. They're negotiating at arm's length and agreeing that whatever the co-founders have founded and are building is worth something. So long ago, we bought these shares for a fraction of a penny, and it looks like they're worth a whole lot more now. The next slide is just, again, demonstrating another round, the Series B round. And so if you go down to that specific line, venture capital B, again, another 3 million shares. This time it's at $1. So we've got $3 million. At the bottom of the column that says fund raise, we've raised over $5 million. And that's where that, talking about it bleeds into the financial statements before, that is your shareholders' equity line on your balance sheet. Okay, so we've got all this money in. We've had a pre-money valuation at this stage of 10.6. The founders, and I'm just in the second column there, or the third column, the founders are diluted down, but they've got 44% of a $13.6 million company. Okay, so yes, they've been diluted, but the pie is way bigger than it was originally. So without raising the money, the shares wouldn't have their value. So founders have to be cognizant or prepared to dilute often. Going to the next slide, we build in the options. And in this case, the option price was 25 cents. So They ended up raising a few more dollars, 375,000. But this shows, after all is said and done, with all the options exercised, we have the ownership percentages. The founders are down to just under 40. The friends and family have been diluted down to 2.5%. Angels are at 8. Venture capitalists are at 20. And our stock option plan, albeit initially was at 19%, has been diluted to just under 10, which again makes a bunch of sense. So, I hope that demonstrates for the group here just how that works and how that's built out. But you can see this share cap table is spelling out at each juncture, who's getting the shares and at what price and how the dilution is affected. And these cap tables can get really complex. So if we go to the next slide, we can see, in this case, I've actually broken it out by share class. And so you can see that over time, we are creating the Series A preferred, the Series B preferred. We see that in each case, the venture capital A's have 100% of that class. The venture capital B's have 100% of that class. And yes, going back to my comment about class votes, those groups have vetoes. So, there are prices to pay. I refer to it as the cost of capital. But if you want their money, they're going to want a separate class. And so you just have to deal with it. And we do deal with it because we have shareholders agreements, investor rights agreements, rights of first refusal, and other documents that are put in place for governing these relationships between the investors, the founders, the angels, and others. I'll stop there. There's lots of information there, so I'm not sure if anything's popping up, but I'll just give folks a chance to type a question if they'd like.
I don't think there's any questions right now. Are there any questions? Okay, there is a question, and that's a question that comes up very often. Who provides these valuations?
Right. So it's a negotiation between typically the company and the investor. As I said at the start, we have to draw the line somewhere. So when those founders are bringing in their friends and family money, we needed to understand, we needed a price. If the company was valued too low, we'd probably give up too much of the company. If the company was too high, then the friends and family wouldn't, really be incentivized to do it. Again, it's putting a understanding what the future is going to hold or what it's going to bring. So again, it's no one really provides specifically the valuation. Certainly in a startup context, if you were to go get a third party professional valuator, a business valuator to price your software, for example, they are going to rely significantly, if not exclusively, on what you tell them, because the business and the product and the market space better than the valuator probably does. And so, you're coming up with it. And then that's where it becomes a negotiation, because at a certain point in time, an investor is going to say anything from, look, I'll give you $100,000, but I want 25% of the company. Okay, well, your pre-money valuation there is $300,000. Is that acceptable to you? If it's too early, you're going to say, there's no way, because you're just giving up too much. And that's when you start shopping. And that's an important component of this whole thing as an entrepreneur raising money, is you got to be prepared to talk to a lot of people to find the right investor. Probably a good time to just talk about, a few of these folks, and we call them friends and family. That's a specific exemption in the securities laws. But really what those people are is those folks that are near and dear, that will write you a check. But if you blow it and you don't succeed, they'll probably invite you back for dinner. They'll probably give you a hug when you next see them, or a present on your birthday. It really is sort of that blood money component of it. And that's what it should be, because they are completely putting all of their faith into you as the co-founder, the entrepreneur, and they're just saying, we believe in your idea. The angels is a different level, right? It's not that. These are typically the accredited investors, or there's a different exemption of some kind from that we've used. But the angel community here is quite sophisticated, and these people are presenting or participating in a whole lot of investments, and they'll look for more. They're going to ask for more bells and whistles in the paper. They're going to ask for information rights. They might ask for a board seat. Friends and family won't do that. Again, they're putting their faith in you that you're going to do something good with their money. Please get me a return, and I don't care when, and if it doesn't work out, fine. The angel is looking for something different. They're actually in the space looking for returns. They understand the risk component. So angels will invest in several companies at the same time, because the numbers show that some win and some lose, and more lose than win. And so they need to sort of participate. But as an angel, they're effectively verging on being the professional investor. Many of them, that's what they do. And so they'll look for more information, have more connection, and they can be extremely helpful for you as well, because not only do they write you a check, but they have industry experience, they have startup experience, they have insights into the community that can really help you. So they have all of their sort of attributes. On the venture capital side, again, sort of taking it to another level of sophistication. But they are typically representing several investors behind them. They're limited partners who are looking for a return. So typically they've pooled more money, so they write bigger checks. And again, that usually leads to more paper, more restrictive covenants, more information. So as you go through this process, the stakes get a little higher. And the asks become a little stronger.
Okay, there's one more question or sort of comment that I'm going to address, Colin. Colin mentions that the models should inform value. I see what you mean, but that's really hard. Just to give us a sort of illustration, we have in a webinar on valuation in general of early stage companies. And basically, if you just base ourselves on theory and what's being used out there, there's already anywhere between 13 to 20 approaches to how to determine valuation. So in this case, Apprentice is just illustrating what happens if you take money from certain investors, what happens to the ownership of the company. So we're not going to attach any value. It's just to show you what happens. Kevin has a good question, and I see why you asked that. Kevin asked Prentice, on the previous slide, how do you calculate the pre-money valuation of 10.8 million?
Right. So that is that's not necessarily me calculating it. It's the hypothetical venture capitalist negotiating with the company. So it's really about wanting to, in my case, make the numbers work. But in reality, the example would be that they would sort of say, okay, we think your company's worth 10.6. We're going to, on that basis, we're willing to write you a check for 3 million in exchange for 20%. So, in this purpose, like, bluntly, the numbers made up, because it's just sort of to make it work and illustrate that at that point in time, that Series B investor, you're approaching them because you're going to another level. You've grown enough with what you've got, well beyond the 3.8 in the earlier side. We're just pegging a number in the sand for the purpose of acquiring so much of the company at so much cents or dollars per share.
Okay, Kevin, and I want to add to that. It's really, and that's why we do workshops like this, because we feel it's really important that both investors, but in particularly entrepreneurs, are also educated that you really can educate yourself on the valuation that you would like to have. And it's really important to find sort of middle ground, because a too low of a valuation is not going to work. A too high one is not going to work either. So it's a process of finding that middle ground. So I hope that helps.
There's far more negotiation in that number than I think people realize.
Yeah.
You know, the entrepreneur will say, you know, I'm worth $5 million. Well, you're only worth $5 million if someone validates that. And the way they validate it is usually through investment or purchase. But, you know, that's really where it comes in. Now, you can say, well, I'm worth $5 million because, and, you know, you build out all of these, I don't know, substantiate the reasons why. You've got sales contracts, you've got a team of, you know, however many people, but, you know, you've got revenue of some kind or pre-revenue traction, and you can demonstrate it. Well, that's fine. That all sort of builds in and helps you legitimize your 5 million, which makes it tougher for the other side to knock you down. But it doesn't mean that that's absolutely what it is. They, you know, you still might end up at 4.5 or 4 or even 5.5. You don't know, but yeah, it's very much a malleable figure rather than fixed.
The what we call our webinar on valuation is called the art of valuation, because there's an art to it. You find the middle ground, you negotiate, you base yourself on facts. It's interesting. Okay, Peter, I do see your question, but we're gonna move on with the presentation. I'll move the slides back to where we were. So are you ready to continue, Quentin?
I'm ready. Yeah. Next one.
Yeah, there we go.
That was a good little break. So let's see, one more. Yeah, there we go. Okay, the whole lot of stuff there about equity. And I think that we're still talking about debt and other things. So let's move there. Many times I get asked this question, debentures or notes, you know, what should we use for we're going to raise some debt? You know, they are the same thing. What it isn't is equity. So, and it's not that third category of grant. So it's going to be a loan. And typically when you're borrowing money, you know, same thing when you buy a house and you get a mortgage, you know, security is involved. And the company is often asked to grant security. It's important too that, you know, even though you're borrowing money and it's a loan, you know, just keep a heads up that there are securities laws exemptions that we need to comply with. A simple promissory note itself is a security and it gets captured by the securities laws. So there's my sort of lawyerly red flag of just make sure you're in compliance and just don't be borrowing willy-nilly or on the fly. You know, the other thing is about just repayment and buttoning down when you're borrowing, what the terms are. You know, often loans are borrowed and they're just on demand. They can be demanded at any time and be required to be repaid. Or of course, there's the term feature, which is, you know, borrow for a month or a year and it's due then. And also just, you know, interest and comparing interest to the grant of security, which is we call a security interest. Two very different types of interests on that front. Okay, so in the context of our companies, we really don't want to be borrowing too much, but and really just because it doesn't look good on the balance sheet. As founders, we often lend money into the company because if we ever do get some revenue, it's a tax-free way to pull it back out. So we buy our shares for really cheap, and we loan any substantive money into the company. But then we skip a few steps, and maybe we're at that angel funding round or venture capital round, and we start talking about debt and convertible debt. And so this next slide we're talking about, sort of this hybrid in between, because companies often get stuck. They can't raise the equity funds because they can't agree on a valuation. And so then they say, okay, well, why don't you just loan me some money and we'll convert it into some shares later on? And that's a really common thing. And we refer to it as bridge financing. But it's the idea for the company is, well, we can't agree on a valuation, but I really need the money. And we're talking to some investors, but they're not ready to invest in equity. So how about you just lend me some money for the time being, and then we'll convert it later into shares. All well and good, happens all the time, but we have to ask ourselves some of these questions. What is the loan going to be convertible into? And it's easy to say shares because that's typically where we'll end up. But are they existing shares or are they future shares? And that's really where we need to sort of, start getting into the details about what this is going to look like. From the investor side, the investor, again, doesn't like the valuation, likes the business, likes the company, but isn't really willing to wait, or is happy to provide the funds or lend the funds on a convertible basis, and that conversion is going to be kicked down when the investors are there. The reason the investor sort of is okay with that, and it goes back to my last slide, is that debt ranks higher than money. Debt ranks higher than equity. So if that investor lends some money, the company has to repay that loan first in a insolvency downward situation, which we don't like to talk about. But if it never got to that point, they would rank higher than the existing shares in terms of distribution of assets. So the secured loan is an attractive element to that. And what an investor might do also is take an security interest or be granted security to check their loan in the intellectual property or the assets of the company. So for the company, we want to convert that loan and get that security interest off there. But again, it's a cost of capital in terms of just, if you want the money, these are sort of the terms that you might be faced with. So we've loaned, the investors provided the funds as a loan, and it has a conversion feature. More questions that are asked in addition to what's it going to convert into is at what price? And again, this is part of the problem and why we're lending the money anyway, is that we couldn't agree on a valuation and we couldn't agree on a price. So often what happens is we'll convert this loan at whatever the financing is that comes in down the road. So, maybe the investors say, okay, we're going to invest at 50 cents a share, and the convertible loan says we are going to convert at the time of that investment at 50 cents a share. But you have to iron that out. You also have to consider whose choice it is. Is it an automatic conversion or not? The next one is, what is that if it's going to convert into a share to be created? What is that going to look like? And when is it going to be issued? So that all these sorts of questions that pop up, that when you start thinking about it, there's a lot more to it than just lend me some money and we'll convert it into shares at some point. We've got to think about, when and how and at what price. And these all become negotiating terms, and in some cases, sticking terms. The next slide is about safes. And a safe is a simple agreement for future equity. Just by its name, you understand that we're talking about future equity and the questions around what that is. Safes are extremely popular, but they really are a convertible note with some other features. They were created, several years ago, and they've seemed to really taken a hold in the startup and venture space, because they're regularly talked about. They're sort of understood. Get there in a bit. They are, in theory, an easy way to raise some money. The terms are fairly standard, and so companies are taking the approach that it's tried and true. It'll work. It's already, for the most part, the terms have already been predetermined, because there are forms of safe circling on the internet. Y Combinator, I think NACO probably has a safe on its site, the Canadian version, but it is an instrument that is commonly referred to and not so well understood. Is it debt or is it equity? It's both. It's sort of a debt instrument because no shares are issued, and you might get your money back based on certain events that happen. It's like a share because you can't actually demand your money back, and it does convert into a share, usually on the next round of financing. The dangers around safes, and there's sort of there's a few different forms, and you'll see most commonly discount rates and valuation caps. And these are really important terms to consider in the safe. So the last slide we were talking about just convertible debt and what's the price that it's going to convert into. If you just have a regular note, you can say whatever the terms are, that it will convert at the same price, at 50 cents, for example, the same price that the equity investors are coming in, or your convertible note can say we will convert at a discount, and maybe that's 20% discount or something like that. The safes have the same feature. They have the discount rate, and that's sort of, there's like three things to insert on a standard boilerplate safe: the valuation cap, the discount, and the name, I guess, the dollar amount that they're actually subscribing for. But it's that discount rate and the valuation cap that's really important to understand, because the valuation cap can create a situation where you're effectively converting, or your price per share is a lot lower than you might think it is. If you are entertaining a safe, the general caveat is, you need to understand what it means, and really in the context of, if you take someone's money, and it's convertible notes as well, it's not just safes, but if you take that convertible money, what's the impact going to be? If it's going to convert in a future equity, you might think that future equity pricing round is going to be 50 cents, but it could also be 10 cents. It could be far lower. You could, with that convertible note, albeit well-intended, convertible note or safe, albeit well-intended, you could actually, as a founder, dilute yourself more than you ever imagined you would be. And so it's really easy to get the money, but all we're doing in these situations is punting down the real question of, what's your valuation? How much are you worth? And so if until we sort of, I guess the recommendation is, push it out as much as you can, try to lock it in, Safes are very much, or the intention was to get some money in the door and really roll into equity within months. But we see them being subscribed for, and it actually will take many months and a year plus to actually roll into, because it really depends on the negotiation of the company with that equity investor that's coming in. Our next slide is, just talking a little bit more about debts and safes. In BC, we have the Small Business Venture Capital Act, which, if those of you who have not heard of it, it is basically legislation that's put in place to incentivize local investment in local companies for the long term. The reason it's important, and the reason why people are so good to it, is because it provides for a 30% tax credit on investments in eligible companies. The reason we bring it up here is because companies, when they're raising money, can qualify for these tax credits, which make investment in them more attractive. The wrinkle is that you can't get EBC tax credits on a loan, but you can get it on a safe. And the rules have changed over the last few years. But and just as an example, at one time, you had to actually have the share issued to you to get your tax credit. And what that meant was, if a safe was issued, you wouldn't be eligible for the tax credit until it actually converted into a share. That's changed. The safe is actually eligible itself now, which is great. Great to get the tax credit. But I encourage you, if you are entertaining it, to just Google safes and tax credits. I just did it yesterday just to make sure that I was sort of up to speed on the topic. But in short, not all safes are created equal, and not all safes qualify. There are a few provisions that sneak into some safes that will disqualify you from the tax credit. And it really is around repayment and the ability to get money back. So a true safe should qualify, and usually does. But in all of our attempts to be cost effective and conscious and efficient, just be careful if you're just pulling any old safe off the shelf, that it does comply, because you want to be ahead of that issue before getting the tax credits, because if you need to pay them back, that's obviously not what you want to be in. You don't want to be in that spot. But the Small Business Venture Capital Act, I mentioned these two features before. It really is about local long-term investing, and the window is, I think, 5 years. So if you're looking to exit in a year, you're probably going to have to pay your tax credits back. Anytime after 2 years, there's usually a proration that you'll have to repay some of that 30 cents. But the concept is, let's invest in our local companies for a longer period of time to make sure that they grow and are successful and the like. Just a little bit more on that. The company has to apply for those credits, and you usually approach the ministry and say, I want to raise $1 million, or whatever the figure is, and the ministry will essentially earmark those funds for you, or that amount raised, and so you can do that. So if for example the company was given the green light for raising $1 million that were eligible for tax credits, and you raised 1.5, that additional $500,000 would not be eligible for the tax credits. They're really helpful at the ministry. Yeah, it's much easier, and they don't like talking to guys like me. They like talking to the entrepreneurs and the founders directly. And I think the clip that I saw on my little quick research yesterday was an invitation. If you think your safe is or you're not sure about whether your safe will be eligible, they invite you to send it over to them to have a look. And that's I knock myself off. That's a lot cheaper than having your local council go over it for you. Okay, the next slide. How are we doing here? We seem to have lots of time. We're flying through things. I'll just take a break maybe for a second before we do this next slide. Irene, is there any other things that have popped up?
There was a question earlier, 2 questions, and I think one has already been answered in the answered in the chat room. VC asked a question like, if I were looking to raise money, an average of 10K to build a facility like Tennis Coquitlam Center, then I would need to find 100 people. Does it sound reasonable to manage 100 investors? So your question is, can we manage 100 shareholders?
Yeah, well, I mean, I think that that really goes to your tolerance for patience and how much you want to deal with investors. It's always easier to get one check for $10,000 than it is to deal with 100 investors that in aggregate give you $10,000. Or $100 each. I'd also, there's some securities laws, things that you need to be careful in there. But back to the specific question, it's always easier to deal with fewer people. The next color commentary on that is those people that are writing larger checks usually ask fewer questions. I know that sounds maybe counterintuitive, but the people that can afford to write those checks are probably writing those checks to more than 1 or even 5 people, and they understand that you need to be working on your project. They understand that you have all sorts of distractions, and all they really ask for is to check in once in a while. That could be quarterly or whatever they ask of you. But it's always easier to deal with fewer investors.
And that is also something that we really recommend entrepreneurs to do when they take angel money, is just to send out an update, like not even every month, but every other month, once a quarter. It's just that provision of information really helps with managing the relationship. And also because in this case, angels are not just there to make money or to give money. They can also help because very often they have a very extensive network. And if you let them know that there's something creeping up and you would need some advice, if they get informed timely, they can help you out. So this whole information provision is a very, very important part of managing the relationship between investors and companies.
Yeah, no, that's a good point, Irene. By operation of the statute, the Business Corporations Act, the company only has to report to its shareholders once a year. And so you'll recognize the term annual general meeting, but the whole purpose of that is once a year, the directors, and usually with the help of management, report to the shareholders and say, they'll provide the financial statements so that you can see what's happened on the financial front. You'll elect the directors, and usually there's a presentation of some kind that to update the shareholders in terms of just on the business front, what's going on or has been going on and what's planned.
Okay, there's another question, sorry, from Jeff. We just touched upon this, Jeff. Jeff asked, why do you as investors favor SAFEs? Is it wise to start with common shares raised early stage, since you can offer BC investors EBC credits for an angel round? We just touched upon that, and that's that SAFEs are now EBC, provided that they are the right kind of SAFEs, they are EBC eligible as well, if the company has applied for that. And then the remainder of his question is, then move to SAFE later to attract US investors as company grows nearing Series A. Well, first, SAFEs were started in the US. That's where they originated from. So would you like to take this question, Prentice?
Yeah, sure. the safes are, as Irene said, they are have been used longer in the U.S. They are increasingly becoming popular in Canada, but it's not necessarily the tool that you use to attract U.S. investment. Again, back to the principles of just wanting to issue shares as your primary source. You should always be looking to do that at a fixed valuation because there's certainty. When an investor isn't sure about the valuation, that's when you introduce other mechanics. So that's where you would, entertain a safe, because again, if you need the money, you're going to get it however you can. And if you need to use a safe, you're going to use it. But the safe isn't as a company, you want to issue shares before you go to the safe. The safe is a backup plan to issuing the equity, because again, there's a reason that you're issuing the safe, and it's usually around valuation that has not been specified or agreed to.
Thank you, Princess. That's it for questions right now.
Okay, great. Okay, so our next slide here is just around. I wanted to bring back the cap table, because this is again another issue that sort of pops up that happens all the time. We're looking at investment from investors. I'm talking to the founder about their cap table. It's looking good, and then something comes up about, oh well, but we've got these other investors. Okay, well, what kind of investors? And they said, well, it's debt. So where do I put them on the cap table? And the answer is, it doesn't go on the cap table because it's debt. The share cap table is all about the equity investment. You can see there, just scrolling down, the convertible, if the debt is convertible, there is a place on the cap table for it, and you should show it on the cap table. Similarly, a safe, again, it's another convertible instrument. And so if any security that you're issuing could become shares, and whether those are common, a preferred, or a future share to be created that you just don't even know what the terms are, there's room for it on the cap table, and it should be there, because again, it's going to provide the snapshot to the reader of dilution or what might be out there. Okay, so Irene, could I get you to flip back to one of the cap table slides, and I'll tell you which one. Let's go to the Series A. I think it's page 15. Great. Okay, thanks. Okay, so I've picked this slide just because we don't have the B's in yet, and the concept of the convertible note or the safe is this bridge mechanism looking towards the next round. Now, obviously, I've got some homework I have to do to this, because I've got to sort of create a new cap table slide that builds in the safes. But looking at this slide, this is an equity cap table. There is no line for a safe. But I just said, and I appreciate that, it's got to go in there somewhere. Where you'd put it is really a footnote. You've raised $250,000 through a safe. The reason it doesn't have a specific line item is because, one, you don't know which shares it might convert into, and you don't know the price of the shares. And so you actually don't know how it's going to affect the dilution and affect the numbers, unless you make a bunch of assumptions. But the assumptions, again, you can compartmentalize them, but my perspective is there are just too many assumptions to be made. There are too many variables to consider to actually have the safes or the convertible notes as a specific line item in your cap table. So what I typically do is, below the cap table, have a footnote that says we have, and using this cap table an example, the company has issued safes in the amount of $250,000 convertible into, right, a future or a class to be created in the future. And so, and the reason it's that vague is because one of two things, I'm gonna have to tweak my example, but the Series B may not be created, so it could go into an A, or if the B is created, only on certain circumstances will it qualify. I mean, it should convert, but again, you haven't created that, so you don't know. You don't know that the Bs are going to subscribe for 20% of the shares. You don't know that the price of the Bs is going to be, in our example, it was $1. There's just too many things. But again, it's important to show the reader of the share cap table that there is actually another instrument out there that could cause dilution. So again, that's really just the punchline to it, is that there is room for it on the cap table, but it's going to be as a footnote or something like that. Okay. Scrolling down then, Irene, just to the end, we've been talking a lot about the equity and the debt and the convertible debt, but this last slide or this next slide is just talking about some of the other portion or other ways to get money. And the only two other ways are a grant or a gift. The reason that it's unlikely that your company is going to be gifted any funds unless you simply agree to perhaps as a founder, gift some money, but I don't think you ever would. You'd always want to convert it into shares of some kind to participate. But the grants are really important to be aware of. And the grants, there's all sorts of government funding out there that startups that are made available to startups that you can qualify for, and incentive plans. And when you combine things like SHRED credits, the scientific research and experimental development credit, IRAP and other things, a $100,000 investment, can be doubled. You can really stretch the dollars. And the benefit of some of these programs is it's access to capital and it's non-dilutive. And there are so many different programs out there, and whether that's a technology specific program or industry specific program, or maybe even it's just women entrepreneurs. I know there's specific funds for groups that whatever your eligibility criteria are, qualify. But I don't think it's sort of easy to talk about, but I don't think I just hear about more and more programs all the time. And so I just caution companies to make sure you do your homework, get out there, talk to people, explain your industry. Do you know what's out there? The concierge, National Research, the NRC group, their job is basically just to make themselves available to help you find funding. So get out there and use it. That's a really important one.
I have one word of advice here. I know of someone who works for one of these programs, but she really knows everything that's out there, and she's able with, if you are an entrepreneur and looking for grants and funding, when she talks to you, she can tell you which programs you might be eligible for. And this person, I'm very happy to share or to introduce you to her. I have gotten feedback from companies that were just like so happy because it saved them a lot of time, because she knows what's out there. She can tell you where to go. She's working for one of those programs, so she's not making any money out of it. So just contact me. I put my email in there, and I'll introduce you to her. Sorry, Prentice.
No, that's great. That's why we're here. We're just making connections and like. So I appreciate that we're sort of 90 minutes here, but it's flown by. I think I learned my lesson last year in terms of sort of going overboard, but I've left lots of time for questions. Just as on the next slide, just sort of wrapping things up, we've covered a whole bunch of ground here. I guess we've talked about equity. We've talked about shares, different classes of shares, different voting rights, some veto rights that sneak up on you. We've talked about debt, and they are a security in the eyes of the regulators. They can have conversion features. These are all, especially the safes and the convertible notes. Again, I said the safes were standardized. Convertible notes, really can take any form that you want. Similar to share rights, special rights and restrictions attached to shares, we can put, all sorts of language in there that is tailored to the needs of the company, the needs of the founders, the needs of the investors. And, I just, again, caution you, it's easy to ask your counsel, ask your investors or whoever, just pull whatever those documents are off the shelf. I don't care, it'll be good. The problem is that, there's a price to pay in that situation, and it could be dear down the road. It might be cheap and effective now to get the money in, but you can pay the price later and just not really realize what you're stepping into. So, be cautious with this paper that backstops the funding. There's all sorts of things that can seem harmless at the start, but can come back to be problematic in the future. Lots of talk. We covered lots of ground on the cap tables. These things can take all sorts of different forms. I usually use Excel if that's of any value to people, but seems to be a workable tool that people can understand. Again, you're always looking at the cap table, whether it's the founder, the CEO, the CFO, whoever's in charge of it. When they're talking to investors, they need that cap table ready in hand because they're going to be looking at it, massaging it, thinking about what the next round would look like, and you're having a fireside chat or a water cooler chat with an investor, and they say, yeah, 25% at $1. Well, having that cap table ready, you can go home and start, playing with the numbers and the formulas and see what impact it has. And it will have an immediate impact. But then I'd say, look forward to that next round of financing, which could be a down round, which could be an up round, whatever it is, and what that dilutive effect will be. Because each time you bring in money, there's going to be a dilutive effect. And you just have to be conscious of, just anticipate it. It's inevitable, but it's understanding, before you go there. That's an important part.